Now let's talk about what happened here today. Ran into an obstacle, and I had a suggestion that we should just give up and go home. No, that is not how we are successful in the world of business. We either find a way or we make one. And so that's what we're doing here. We're being flexible, we're finding a way. Okay, last time we talked about, so we're talking about the cost of capital, and we said there was the equity capital and the debt. And we talked last time about how we're going to find that cost of equity capital. And there were two ways to do it. Can anyone tell me what they were? Mr. Scott, what were they?
I felt like you were going to pick on me.
Okay.
Financial leverage and base.
Oh, you're just picking two things off your notes.
One of them was the security market bond.
Very good. And the other one? Oh, he's got a peek. Okay, that's the same thing as security market line.
Was it the dividend?
The dividend discount model. Now, I will point out that two things. Number one, Mr. Bowrichter wasn't with us last time, and number two, he has a fresh haircut. So I think he skipped class to get his haircut. I think it was worth it. Okay. Now, we've talked about how to find the cost of equity. Now we're going to talk about how to find the cost of debt, and it's a whole lot easier. It turns out that all we have to do is find the yield to maturity on the debt for the firm. And so we know how to find yield to maturity from Chapter 5, and so it's really easy for us to find that. Now, I actually think that remember, yield to maturity is an APR, and for a semi-annual bond, the effective annual rate is going to be higher than that yield to maturity, but the convention is that we use yield to maturity, not the effective rate. So apparently the convention thinks that I'm not correct. Now, the other thing that we need to keep in mind, though, is that interest is tax deductible. If you think back to income statements, you subtract the interest out before you calculate your taxes. And so this is something we're going to have to make an adjustment for as we go here. Now, before we go too far with this, I want to point out something, and that is that not every single issue of debt for a firm will have exactly the same yield to maturity. Even though the risks of the firm are the same, remember in Chapter 5 we talked about how bonds with different covenants can have different levels of risk. Bonds with different features can have different levels of risk. For instance, a callable bond would be riskier than a non-callable bond. And so it would have to have a higher yield to maturity. So if a firm had some non-callable bonds and some callable bonds, they would have two different yield to maturity. So how do we figure out how to get the yield to maturity for the overall firm? It's the weighted average. It's the weighted average. And so I'm going to give you an example here, and I'm just going to make it up as we go along. Okay, so issue A has 1,000 bonds, and it is currently priced at $990. By the way, is that a discount bond or a premium bond? Yeah, it's a discount bond because it's selling for less than face value. Okay, so what is the market value of those bonds? And by the way, all these weights that we've been talking about, E and D, B, S, whatever you want to call them, those are all market values, not book values, market values. And so we're going to take 1,000 times 990. So I think that gives us 990,000. Does that sound right? Okay. Now, issue B, let's say, just to make the math easy, it's got 100 bonds, and each one of those is selling for $1,010. And so what we end up with here is 101000. Tell me if I've made a mistake. Should have, what, 3 zeros there? 101. 100, so I'm just adding 2 zeros to this thing. There we go. Okay, now let's make one more bond issue here. And let's say it is also 100, and each one of these bonds is worth $1,000. By the way, premium or discount bond? Premium. What's this thing called? Par bond. Very good. And so what we're looking at here is 100,000. Okay, so now what I can do is add all of this up. So I've got 201,000 plus 990. So what have I got here? I got 1 million. I think this is my COVID last. So this would be $1 million, right? But we're about $1,000 short. So $1 million plus, oh, and this one is, so $1 million plus 201,000 would be, actually this is 10,000 short, right? $1 million plus 201,000 would be 1.201 million, and we're short by 10, so 1.9, let's see, 191. 191, is that right? Whew. Crippled brain, and I can still do it without a calculator. Okay, now, if you had to guess, oh, by the way, yield to maturity. 5%, 6%, 4%. What do you think we're going to do? Any ideas? Think about portfolios. How do we find the expected return on a portfolio? Mr. Fisher, you look like it was on the tip of your tongue.
From average
Okay, what kind of average? Are we just going to add them together and divide by 3?
and multiply by the weights.
Yeah, we're going to have to come up with some weights. Man, he's on fire today. Okay, so first thing I'm going to do is I'm going to find out the weights. And those weights are 990,000 divided by 1.1. Okay, so I can't do that math in my head, so here we go. 990,000 divided by 1,191,000. That's the weight on A. Weight on B. 101,000 divided by 1,191,000. And then this one will be 100,000 divided by 1,191,000. And so you can do those out in your calculator. And here's what we're going to find. The yield to maturity for the overall company is going to be XA times the yield to maturity on A plus XB times the yield to maturity on B plus XC times the yield to maturity on C. It's just a weighted average of the yield to maturities based on the market values. And by the way, this number comes in handy because later on we're going to use that as our market value of the debt when we figure out the weighted average cost of capital for the overall firm. He left. He got the question right, and then he left. What is wrong with you today? Okay. Questions? Okay, so now we know how to find the required return on the equity. We know how to find the required return on the debt. And so we need to be able to find this firm's weighted average cost of capital using those two things. And you might think it's really easy. All we're going to do is take the proportion of the capital structure that is equity, multiply it by the required return on equity, and then we're going to take the part of the capital structure that is debt and multiply it by the required return on the debt. Except for one little problem. Remember earlier we said something about debt and taxes. What was it? Interest is? Tax deductible. Are dividends tax deductible? No. Are capital gains to our shareholders tax deductible? No. And so we're going to have to treat debt a little differently than we treat equity. And that's why we're multiplying by this 1 minus T sub C. T sub C is the corporate tax rate. Corporate tax rate. And I would tell you what the corporate tax rate is, but there are two things. You guys know from your review of chapter 2, it's progressive, right? So it's different depending on who you are or how much money you're making. And it also changes as a result of legislation. And so we had some new tax law come into effect in 2017, and I believe it has a sunset provision. And so everything's gonna go back to the way it was, so who knows? So if you're gonna try to find out what the current tax rate is for your company, where would you go? Say again?
IRS.
Yeah, the IRS, the Internal Revenue Service. They have all these documents and whatnot, and they're not very well written, but they do have the number that you need. Okay, now let's see what else we want to talk about here. I think we've basically got it. Remember, E divided by D plus E. E is equity. What's D? Debt. And what's D plus E? You okay?
Yes, I believe that was
Okay. D plus E, what does that represent? The total value of... So what's blank is equal to liability plus owner's equity? Assets. So that's the total assets of the firm. And so E over D plus E is basically just the proportion of the assets that are financed with equity. D over D plus E is the proportion of the assets that are financed with debt. Okay, so let's do a WACC example. By the way, we call this WACC, which is short for weighted average cost of capital. What did Whitney Houston say about crack? Oh, you guys don't even know who Whitney Houston is, do you? You know who she is? She said, she was in an interview with Diane Sawyer. Diane Sawyer asked her if she'd ever used cocaine. She said, yeah. And then she asked her about crack. And she says, no way! Crack is whack! Okay, I gotta stop using that joke because you guys are way too young to remember any of that. Okay, so this is not the same WACC. That's my point to you there. This is not the same WACC. This is the weighted average cost of capital. So let's do a little example here. Your firm is financed with 2/3 debt and 1/3 equity. Lucky you, I didn't even make you calculate those weights. However, I could have told you that D is 2 and E is 1. And you could have calculated all that for yourselves. Does that make sense? Okay, so the required return on equity is 15%. The required return on debt is 12%. Can anyone tell me why the required return on equity should be higher than the required return on debt? I'm going to go with Ms. Wabi.
I'm not listening.
You're not listening.
No, I'm not
I
writing.
appreciate your honesty. So let's try this again. Can you tell me, Ms. Wabi,
Okay.
why the required return on equity should be higher than the required return on debt?
It's risky.
It's riskier, and why is it riskier?
Because it is.
Because it is. We're not going to accept that as an answer. Let's see. Who else can I pick on? I already picked on Mr. Bauerichter about his hair today. Ms. Menace. Why should equity have a higher return than debt?
You're not guaranteed any money back.
Yeah, think about this. It's the order in which people get paid, right? When the company gets any money, they pay the coupons on the debt first, and then the shareholders are down here at the end. They're getting any kind of leftovers, the residual claim. And so as a bondholder, you are more likely to get paid. And so therefore, your position as a bondholder is less risky. And as a result, the required return on debt is lower than the required return on equity. Does that make sense? Okay. Now, the corporate tax rate, we're just giving it here as 25%. And so we are now going to talk about how to figure out the weighted average cost of capital. We're going to take that weight on equity, which we said was 1/3. We're going to multiply it by that required return on equity, which we've been told is 15%. We're going to then add the proportion of the capital structure that is debt, which is 2/3, multiplied by the required return on debt, which is 12%, multiplied by 1 minus T sub C to take account of that tax deductibility of interest. What is 1/3 of 15? 5, very good. What is 2/3 of 12? 8. I think it's 8, isn't it? Yeah, it's 8. What is 8 times 0.75? What is 3/4 of 8? 6, right? So what we've got here is 5 plus 6. That gives us our required, our weighted average cost of capital of 11%. Now I want to point something out here. When you're working these problems, if they just tell you the yield to maturity on the debt, or they say the cost of debt is, or they say the before tax of cost of debt is, then you're going to use that as R sub debt. But what if they say that they give you the after tax cost of debt? Ooh, this eraser stinks. After tax cost of debt. It's equal to the before tax cost of debt multiplied by, what do you think? Yeah, 1 minus T sub C. And so basically, this is just your R debt times 1 minus T sub C. So if I give you the after-tax cost of debt, do you need to multiply that by 1 minus T sub C? No. It's just like when I give you market risk premium. It's already got the risk-free rate subtracted out. You don't need to do anything about it. So be careful to read to find out whether you've been given the before-tax cost of debt or the after-tax cost of debt. And I'll tell you this, if it doesn't say after-tax cost of debt, you can almost be certain that they're giving you the before-tax cost of debt. Questions?
It would be super mean if they just find the tax rate right.
Oh my goodness, that's an amazing
What?
idea. So when you guys see that on the next exam, you
No, that
can
would take too much time.
thank Ms. Perry. No, I wouldn't. No, I wouldn't. Oh,
I was thinking like that would take forever to find the tax rate, then have to do all of this. And...
no. Oh, no, no. Oh, you're talking
Like
about
on a
using the
test.
table and all that? No, no,
Yeah.
no. I'll just give you the tax rate. I thought you were meaning to algebraically solve for the tax rate.
No, I was
given-
talking about finding the marginal tax
No,
rate.
don't worry about it. No, I'll just give it to you. It'll be one single number,
Okay.
quick and dirty, no problems. All right. Questions? And if the first part of your question, will I be super mean? Of course, the answer is yes. Now, let's talk about projects that are more or less risky than the company itself. So far, we've got the weighted average cost of capital. And that tells you that given the risk of the company overall and how it's financed, what are we required to pay? Now, what if you've got projects that you're examining and they might be riskier or less risky than the overall company? And so let me give you an example here. We have Nissan. Nissan, are you guys familiar with Nissan? I know like two of them. Nissan, actually three. So Nissan is just a standard car company. And then they make this car called the Altima. Are you familiar with the Altima? It's a boring kind of car a kindergarten teacher might drive. It's nothing exciting or sexy. The market is well proven for mid-sized sedans. We know what it is. We know it's on the decline, but we know what it is. The car uses a standard engine. It uses a proven transmission. There is nothing new, exciting, or sexy about the Altima. If I were working for Nissan and I needed to find the required rate of return for building a new Altima plant, I would use exactly the weighted average cost of capital that I could get for Nissan, the overall company. That would be perfectly fine. But what if I were going to do something new? A while back, Nissan decided they were going to make an electric car. And this electric car, the first one they made was called the Leaf. Are you guys familiar with the Leaf? What a silly name for a car. Oh, that's sexy. I want that. A Leaf. I've got more of those in my yard than I care to deal with. Okay, back to the story. Nissan Leaf. It's powered by a battery. Now, let's talk about why that might be a riskier undertaking than a regular old boring car like the Altima. Any ideas?
Because it's not
Say again?
It has not proven itself.
Yeah, and so is there a proven market for it? Actually, at this point, you guys probably say there is, but I'm going to tell you that there's not.
I was gonna say, I think back when it came out, the Prius was pretty newish.
Yeah, and the Prius isn't purely electric,
Yeah.
right? So you got all your granolas, I'm sorry, you've got all your environmentally conscious people who are driving Priuses and flying in private jets, of course, if they're Hollywood types. But you're right, there was the Prius, but it wasn't a pure electric. So now we've got this new pure electric thing on the scene. It's an unproven market. What about the technology? Is it proven technology? No. In fact, let's talk about where you store the energy in an electric car. What's the thing called? Battery, right? And in fact, it uses the same kind of thing that we have here in the laptop, right? It's a lithium polymer something or other battery. Now, these batteries have it. Oh, well, by the way, where do you put the battery in the car? Battery's going to be the most heavy part of the car. Mr. Fisher says you put it underneath. And the reason you do that, I'm going to give he's on a hot streak today. Do you know why?
Weight.
Yeah, okay. And
Weight distribution.
the center of gravity.
Yeah.
We got to keep, so keep in mind, former mechanical engineer here. I don't remember much, but I do remember this. The lower the center of gravity for a vehicle is, the better it handles. If you've got a really tall vehicle like those Ford Transit vans that have the extra high forehead, going around corners, what is likely to happen? Whoop, right? And so they're like, hey, we got this opportunity to put the weight down in the car, the weight down in the car. Now, this sounds good except for one thing. Where are you sitting when you're driving the car? Directly on top of the battery. Now, so far, this doesn't sound bad except for one thing. These batteries have shown a terrible tendency to do something. Mr. Bowrichter, what is it?
Catch on fire.
Catch on fire! These batteries, and you guys have probably seen it on TikTok with a Tesla big flaming ball of fire, right? And everyone's going, because like they're driving Hyundais. Okay, so now I want you to follow the bouncing ball. You are sitting on a battery that's now on fire. Talk about your chestnuts roasting on an open fire, right? Does this sound risky? Yeah. So for all these reasons that we've just covered, if I were going to build a factory to build an electric car, could I just use the firm's overall weighted average cost of capital? No. I'm going to have to use something higher because we know that risk and reward must go together. Does that make sense? Okay, now, there are a couple of ways that we go about it. The best way is to find a pure play company. What is a pure play company? A pure play company is someone that is doing exactly whatever this project is that you're trying to do and nothing else. Exactly what you're trying to do and nothing else. And then find out their weighted average cost of capital. And whatever their weighted average cost of capital should be the required return for your risky project. Because after all, the market has already priced the risk of that thing you're trying to do. How often do you think that really is an option for you?
Pretty much never.
It's not. So let's think about Nissan back in the day. Tesla was just still a glimmer in someone's eye, right? There weren't any pure play electric car companies of any note, none that were publicly traded. And so they couldn't do that. And you're going to find it's pretty hard for you to find pure play companies to look at. And so what do we end up doing? Sometimes companies have what's called it's just a simple bump up or bump down for bump up for riskier projects and a bump down for safer ones. So let's say that the weighted average cost of capital is 6%. And so they might say, well, for riskier projects, we're going to bump up by 3%. And for safer projects, we're going to bump down by 3%. And this sounds logical, but it leads to, I'm going to teach you an industrial term here, and it's a little crass. Are you ready? Are you preparing your... Okay. This leads to pissing contests. Are you familiar with pissing contests? Okay, so here's the pissing contest. We go in for our capital budgeting. By the way, we all have projects that we would like to get approved, right? I would like to get my machine, Dave would like to get his, and so forth. And so we're going to go in there, and we know that the lower this rate is, the more likely our project is going to have a positive net present value. The more likely the project is to be accepted. And so we get into the room, and what does everybody immediately start to argue about their project? Do they say, oh, this crap's risky. It's like running around in a gasoline G-string in front of open flames. Do they say that? No. What do they say instead? Oh, yeah, this thing's really, really safe. Yeah, really, really safe. Now, I'm not a natural-born liar, so I was really bad at this game. But I know people who are great at it. And by the way, they got promoted. I'm not telling you that that's what you should do, right? My point to you is this. If you get into one of these situations, it leads to people lying, and that leads to bad decisions. Yet we still see people doing it. But there's actually a worse thing that people do, and I'll get to that in a little bit. Any questions so far? Okay. Now, what we're looking at here is the security market line. That's that blue thing. It's the security market line. And remember that what the risk that we're concerned about is beta, or the systematic risk. And so theoretically, every project out there has a beta. I'm not going to teach you how to calculate that. It would be very difficult to do, but every project out there has a beta. And so in theory, knowing that beta, knowing the required return on the market, knowing the risk-free rate, I can figure out what that project should return. And that would be that blue security market line arrow there. If the project is above that blue line, it would be a positive net present value project. In other words, it would be expanding shareholder wealth. If the project was below that blue line, it would be a negative net present value project. It would actually be destroying shareholder wealth. Okay, so we know that the blue line is how we should be making our decisions, but instead, a lot of times firms just use their overall cost of capital as the only rate, and that's all they use when they as a discount rate for every project, regardless of risk. Let's look at how that can lead to some bad decisions. So, if we look at this this one over here on the left-hand side, the black dot, notice that it's above the security market line. Therefore, we know it's a positive net present value project, and the rule is that we accept all positive net present value projects. So we should accept it, but when we're comparing it to the weighted average cost of capital, does it make the cut? No, it's below the weighted average cost of capital, and so we would reject it. So it's a good project, and we're rejecting it. And it's also a safe project, and we're rejecting it. Now look over here on the right-hand side. We have a project that is above the weighted average cost of capital, and therefore would be accepted by a firm that's doing this one cost of capital for everything model. But where is it compared to the security market line? It's below. Is that a positive or negative net present value project? It's negative. It's going to destroy shareholder wealth. Should we accept that project? Oh, come on, folks. Should we accept something that's going to destroy? What's the goal of financial management? Right? It all comes back to that. If it's destroying shareholder wealth, run away from it. Maybe I should ask you this. Do you like to lose money? No, right? Okay. So we are going to select this loser project even though it's going to destroy shareholder wealth simply because it returns more than the firm's overall cost of capital, which is the weighted average cost of capital. And here's the problem. Well, there's more than one problem here. First of all, we are foregoing some good projects. And remember, the goal is to maximize shareholder wealth. If I'm going to maximize shareholder wealth, I better be accepting projects like the one on the left. And I am accepting these negative NPV projects over on the right-hand side. And over time, what this leads to is the firm's assets becoming riskier and riskier. Can anyone tell me why? Ms. Caviani, any ideas?
Of why it's
Why over time would doing the single cost of capital lead our assets to become riskier and riskier? I'll get you started. Because we're rejecting,
the negative.
oh no, we should, but we're not. We're rejecting the low risk projects. And what are we accepting? The high risk projects. Now, folks, there's nothing wrong with a firm getting riskier as long as there's return to go along with it. But is that the case in this situation? No, we got two triangles there where we are not doing the right thing according to maximizing shareholder wealth. So, we're destroying shareholder value, and we are also making the firm riskier and riskier over time. This is a bad deal. Now that you know that, you probably are saying to yourself, no one would be stupid enough to use a single weighted average cost of capital for every project at the firm. Let me tell you that when I worked at Halliburton, Fortune 500 company, I walked in and we were talking about this, and one of the things that my boss said is, we use the same cost of capital for every single project. And I can remember to this day it was 11.9%. 11.9% was our required return on the capital. And it didn't matter how safe the project was or how risky the project was. And so my projects over here were pretty safe, low risk kinds of stuff, because the products that I was working on, it was a proven market, proven technology, probably around 100 years old, and nothing like that that's going to cause all sorts of troubles. Now, on the other hand, and I was in Dallas, Texas, we had a plant over in Fort Worth, Texas, that was making these instruments that you send down into the oil well to figure out where the oil is in the ground. And they would use all sorts of experimental, weird technology. For instance, they used a neutron generator, which is, you guys know what neutrons are? Subatomic particle, neutral charge, heavy weight. And they would bombard the formation with those and then listen for the echo. I mean, that's some pretty weird, high-risk kind of tech. In fact, here's how high-risk it was. We accidentally sold some of those to the Libyans when we got in trouble because they were also, you could use them as an atomic bomb trigger. That's the kind of technology we're talking about. And so we've got all these computer algorithms, all this kind of crazy stuff. Plus, when you're doing exploratory oil well stuff, do you think that's riskier than working on completed oil wells, which is where my stuff is going? Oh yeah. So there was a lot more risk on that side. And these people would propose these projects, and they would get accepted, even though I'm quite sure that they didn't quite reach the security market line. On the other hand, I'm pitching projects over here for my safe deal, and they're getting rejected because they don't quite reach that weighted average cost of capital. Okay, you say, okay, well that's the oil field. They're probably just a bunch of morons. They probably don't know any better. Example number 2. I was talking to one of our alums, and he was, I think his title was Vice President of the Customer Experience at Walmart. And so he introduces himself, and I introduce myself. I said, well, I'm a finance professor. I probably wouldn't have, much I don't know anything about what you do. He says, oh, no. He says, every single project that we come up with, we have to send it to the finance department to see if it meets the hurdle rate. I said, ooh, tell me about the hurdle rate. And he says, well, it's the weighted average cost of capital for the firm. Walmart, and even back in 1993 when I worked there at the corporate headquarters, they had like Harvard MBAs, people from Harvard working there who were in their finance department, right? Harvard MBAs. And they're making this mistake. So what does that tell you? the education at MSU is better than the education at Harvard because you guys know not to do this crap, right? Now let's talk about the different kinds of things at Walmart, this whole customer experience thing. It used to be, and it's getting much better than it used to be because you can do pickup now out in the parking lot. It used to be the lines at Walmart were long and tedious and painful. You know, I've seen people change diapers, give birth. It's just sad, right? And so what are some technologies that you could adopt? You could adopt the regular check stand with the checker, right? And so that might be something that would be reasonable to use your weighted average cost of capital. But what about self-checkout? Was self-checkout as safe as the check stand? No. Why? Yeah, it's easier to steal with self-checkout, says the man with the knit cap pulled down over. You look like a burglar. Only you need to use it in black, right? Gray doesn't work for burgling, except maybe on cloudy days. Back to the story. Burgling. Burgling's a real word. Look it up. Okay, back to the story. It's easier to steal at self-checkout. And now, I just signed up yesterday for something at Hy-Vee, and it's where I scan my own groceries as I go along, and then I just walk out the door. Do you think that's perhaps even scarier? Yeah, there's even more chance of people stealing stuff using that technology. And so you should be having a higher rate of return for those projects, but Walmart apparently doesn't feel that way. What are the other risks with adoption of new technology? People might not use it. Or you got people like my mom, she's 81. She goes to the self-checkout stand and she tries to shove the crumpled dollar bills in there, one after another. Yeah. So the other risks that, first of all, that people won't adopt the technology, or two, they'll adopt it and abuse it, you know, like my mom. Okay, so those things have to have higher rates of return. Walmart would not, or at least they didn't used to, adjust for the riskiness of the project. Questions? Yeah, go ahead.
So in this dilemma, what do we do? Is there like, I want to make rent, looking at the secret market line, is it possible we can just use a rate where the secret market line, I said with the firms around cost of capital?
Okay, so surely if we were going to do this absolutely correctly, we would follow the security market line as our guideline. Now, and remember the bump up, bump down? It would have 3 lines on this, right? And then we would have, so by the way, at how many points is this correct to use the firm's overall cost of capital? Just look where they cross. How many points do they cross at? 1, right? If we do the bump up, bump down, we have now 3 points where they cross. So that's why I told you earlier that that's a little better, but it's not much better, because now we have 3 chances of being right instead of just 1. Now, what are you saying? You're asking, what are you asking?
This is in between 2 evils, so like, which one is the better evil?
Oh, okay, you're saying what's the lesser evil?
Like, yeah, the lesser
Oh,
evil.
okay, so bump up, bump down is a lesser evil than this, even though it leads to these line contests. But it's like 1/3 is evil, but it's still evil. Okay, and what is 100% good? Following the security market line. And this is the part that I'm loath to admit. Why can't we use the security market line like this? It's really hard to figure out what the beta of a project is, right? Sadly. So I'm telling you, in an
So
ideal
what
world,
about the betas you give us? Like, how do
the
you figure
beta
it
of
out?
the equities for stocks, we can actually go out in the market, find them, right? We use remember linear regression? We can actually use the market to tell us what the beta of a company's stock is. But can we use that to figure out what the beta of an electric car factory is? No. So I'm telling you a lot of things here that are the ideal. And what I want you to do is get as close to that as possible. Bump up, bump down is better than this. And pure play is even better than bump up, bump down. But it's extraordinarily hard to find. Does that make sense? In fact, pure play is how, the only way we would know for sure what the actual beta is of a project. I'm sorry to disappoint you, Mr. Orson.
I have your contact, so if I come in contact with you,
Oh,
somewhere
yeah.
I email you.
So I still have, to this day, I have people that had me 10, 15 years ago, oh, I feel old, 10, 15 years ago, and they will email me and they'll say, I don't know if you remember me. And I'm like, yes, I remember you. They say, I'm working for this company now, and we've got this extra cash, and this is what the company is considering doing. What should we do? And I'll tell them, now it's just one guy's opinion here, but theory would tell us we should do it, right? And I like to tell people if you've got extra cash, you should give it back to the shareholders in the form of dividends or repurchases. But all too often, the people that are reaching out to me are with these like electrical cooperatives. Who are the shareholders? It gets a little fuzzy at that point, right? So I always can tell you what the ideal is, and then hopefully you can figure out how to apply it. If not, I'll try to help you. Right. Oh yeah, and it's not just limited to people in the U.S. I have people in China emailing me, asking me about stuff. And I say, well, I don't know about Chinese accounting, right? 'Cause it's definitely different than what we use. Oh, whew. No, don't do that. Okay, there we go. Question before we move on. So now we're going to talk about flotation costs. Does anyone remember what a sinking fund was for with bonds? Sinking.
Is it to accumulate, like to build up money over time?
To do what?
To do what?
You're right. We're building up money over time, and it's related to bonds. What are we going to do with that money? Yeah, we're going to buy back the bonds, right, to get down that principal over time. And so this is that's sinking. This is the opposite, would be floating. So if we're trying to pay down debt, we are sinking that debt issue. If we are borrowing new money, we are floating the issue. And you can also float equity. So we talk about the cost that it takes to raise money. That's basically the flotation cost, is the cost that it takes to raise money. Now, why does it cost money to raise money? You have to work with someone called an investment banker. Now, if I just say the words investment banker, I want you to picture in your head what kind of car you think an investment banker might drive. Do you guys have the car pictured in your head? Mr. Bowricker's working on it, I can tell. Okay, anyone want to volunteer what the car is that they had in there? Say again? Nissan Altima, oh my goodness. The biggest loser investment banker in the world who is 1 minute away from being fired would be driving a Nissan Altima.
That's good. I'm playing like Lexus,
Oh!
Mercedes.
She's saying Lexus, Mercedes, not a very successful one.
Rolls Royce.
Rolls Royce, now you're getting in the neighborhood. Ferrari, Lamborghini. In fact, the best day, so basically the investment banks all come out with their bonuses once a year, and it's all about the same time. And as soon as the bonuses hit, there's a line that forms at the Manhattan Ferrari dealership. Yeah, I'm not kidding. And so a successful investment banker makes a lot of money. Now you're saying, woohoo, I want to do that. I'm like, yeah, if you want to have a high-stress job and be dead by 50, go ahead. But back to the story. Where do you think the money comes from for the bonuses for the Ferraris? These people are out there raising money for companies, and in doing so, they get a cut of the money that you raise. And so it's a percentage, and that percentage is going to be higher for raising equity than for debt. Let's talk about why that would be. First of all, what's riskier, equity or debt? Equity, right? Equity. Uh-oh, did you swing and miss that time? Well, so you were up by 5, so now we're just going to say you're up by 4. You're still positive for the day, so good for you. Okay, so equity is more risky. Now, here's what you need to know. This is the way investment banking works. Here's the company over here, And here are the institutional investors, retail investors, and that sort of thing. So what the investment banker does is they take a bunch of money and they buy up either the shares or the bonds of the company that's doing the flotation to raise the money. And then they turn around and they sell that to institutional investors, mutual funds, retail investors, that sort of thing. But in this time period, when they're turning around from buying these and coming over here to selling them, they have an inventory of the securities. And so therefore, they are undergoing inventory risk. What happens if the price of that stuff goes down while they're holding on to it? Yeah, they're going to lose money. And I can give you an excellent example of this right now. You know Carvana? What is Carvana? Yeah, they buy and sell used cars, and how do they do it?
They like come pick up your car.
Yeah, it's all online, right? Okay, now Carvana, to support this model, they went out and bought up a bunch of inventory at the peak of used car prices. And now used car prices are down 10 to 15%, and they're still holding on to all these used cars. What's going to happen to them? Going to lose money, right? That's why it's flotation cost for equity has to be higher, because the chances of the price of those securities changing, or the market's perceived price of them changing while they're holding on to them, is higher. Okay, so some of you are saying, well, wait a minute, that means we should raise all of the money as debt, right? Because the flotation costs are lower. But we'll talk about why that's a bad idea here in a little bit. Now, even though we talk about flotation costs in terms of percentages, you actually need to consider it up front as a cash expense. Let's assume that flotation costs are 7%, and you go out and raise $100 million. That is a $7 million expense at time zero of your project. You treat it as a single cash flow at the beginning. You will actually see some finance textbooks that say the weighted average flotation cost, which we're going to get to, should just be added to the weighted average capital cost. Those people are full of crap. That is absolutely untrue. It is a single cash flow at time zero, because that's the way this thing works. When I issue that $100 million in new securities, the investment banker keeps $7 million, and someone gets a new Ferrari. Does that make sense? Okay. Now, let's see. I think that's all I want to tell you here. So, when we figure the flotation costs for a project, we need to assume that the capital structure of the company is going to remain constant. And let's talk about why that is. Remember earlier we said that debt has this tax advantage. And so you might think, aha, I'm going to do 99% debt, or 99% debt and 1% equity to fund my company. Why might that be a bad idea? What happens if you go out and borrow a bunch of money? What happens to your probability of going bankrupt? It goes up, right? The more money you owe, the higher your chance of going bankrupt is. And when you go bankrupt, there's a cost to that. There is this, and it's really hard for us to define it, and we've had trouble over the years. But what you need to understand is what these people have to do is weigh that tax benefit of debt versus the expected cost of financial distress. And when they reach that balance point, you want to stay with it. And so what we see is that different industries have different capital structures. For example, electric utilities tend to work with about 50% equity and 50% debt. And that's because of the risks in their business. That's how this whole thing comes weighted out. What about high-tech firms? High-tech firms have very little debt and a lot of equity, because even though they would like that tax savings, their cash flows are irregular, and it's much easier for them to go bankrupt. And so, let's see, how about this one? Would you loan money to a firm that had 90% debt in its capital structure? You're saying no. Now, let's ask this question. How many of you have a bank account? Every single one of you with a bank account is loaning money to someone with 90% debt in their capital structure. That's the standard capital structure for banks. And why is that okay for banks? They've got a very diversified portfolio. They're loaning money to bunches and bunches of people. They're not allowed to have any more than a set percentage of their loans out to any particular sector. And so it's actually much safer. Their cash flows are much safer, and so they can run on a higher level of debt. Does that make sense? Okay, now that you know that every firm should have some sort of optimal or target capital ratio, let's ask this. If we assume we're at that optimal target capital ratio, what would happen if I go out and fund every new project with debt? What's going to happen to my debt to equity ratio? It's going to start to, Mr. Sadai. If I go out and fund every new project with debt, what's going to happen to my debt to equity ratio?
Debt to equity ratio is going to be, that's going to be high. The ratio.
Yeah, it's going to go up, right? And we're going to slowly move away from that optimal capital structure. And that's going to raise our expected cost of financial distress. Will no longer be at that perfect balance that we're currently at. And so that is why we say, regardless of how you're actually going to fund the project, what you always use is the weighted average flotation cost, assuming that we issue debt and equity in the same proportions that we have in our capital structure right now. If it's a $100 million project and I'm at a debt to equity ratio of 1, I should be going out and raise $50 million in debt and $50 million in stock. Does that make sense? Okay. Now, does that mean that we're always going to raise debt for a project? No. Does it mean we're always going to raise equity for a project? No. We could go back and forth as long as, when we put it all together, we manage to maintain that optimal debt to equity ratio. Questions? Okay, so here is our formula for weighted average flotation cost. Now keep in mind these are percentages, and we're going to convert these percentages here in a little bit. But we use F sub O, or F sub 0, for the weighted average flotation cost. Do you recognize the weights? Yeah, they're exactly the same weights that we were using for the weighted average cost of capital. And we have F sub S is the flotation cost for stocks. F sub B is the flotation cost for bonds. Which one of those is going to be greater? F sub S or F sub B? Oh, swing and a miss. What's riskier, stocks or bonds? Stocks. The inventory risk at the underwriter tells us that the flotation cost for stock has to be higher because they are bearing a greater price risk. Well, they hold on to that. Okay, so F sub S is going to be greater than F sub B. Now, I want you to note something here. There is no 1 minus T sub C here. There is no 1 minus T sub C here because there is no difference in the tax deductibility of costs between the flotation costs of stocks and flotation costs for bonds. So there is no 1 minus T here. So that is the main difference between this and the weighted average cost of capital formula, is that we don't have that 1 minus T piece at the very end. Questions? Okay. Now, here's the cool thing. Think back to net income. We say that net income flows to two places. What are they? I'll give you a hint. Dividends is one of them. The other one is retained earnings. Retained earnings show up on the balance sheet in which section? Yeah, the equity. And so we call that internal equity. And so if I have some retained earnings, that's internal equity, do I need to go out and sell shares to raise that money? No. And so there is no flotation cost if we are using internal equity. There's no flotation cost if we're using internal equity. And so your flotation cost for that equity is 0. And so if we look back at this formula, and we assume that all the equity is internal, that whole first term with the F sub S goes away because F sub S is equal to 0. Okay, so here is our example. We are financed half with debt and half with equity. The flotation cost of debt 5% and the flotation cost for stock 15%. Now let me tell you this, just from the historical stuff that I've read, flotation cost for stock is really actually around 7.5%, which is still huge. Think about a company going out and floating $1 billion IPO, and they're keeping 7.5% of that at the investment bank. That's amazing, right? Okay, so what's our weighted average flotation cost? Well, we're going to have that the weight of equity, it's equity divided by the total value of the firm, and we said that it's half and half, right? So both those weights are 0.5. So 0.5 times 15% comes out to 7.5%. And then for the debt, we've got 0.5 times 5%, which is 2.5%. 7.5 plus 2.5 gives us 10. So our weighted average flotation cost is 10%. Now, here's the problem. You need to raise 100 million. If you go straight out there and just raise 100 million and your weighted average flotation cost is 10%, how much money are you actually going to get in your hands? Yeah, you're going to get 90 million. And so if you actually needed 100 million to buy a factory or to build a factory, buy another company, and then you only issued 100 million, you're only going to get 90 million. You're not going to have enough to do the job. And so what does that mean? It means we need to go out and raise more than the amount that we actually need for the project in order to be able to raise enough money to also pay those flotation costs. And so we can think about it this way. The amount that we need has to be equal to the amount that we raise times 1 minus F sub 0. The amount that we need, that's the upfront cash flow for the project, right? We need 100 million. That's the amount that we're going to have over here for amount needed. And that amount to be raised, we don't know yet, but we know that whatever that is multiplied by 1 minus F sub 0 is going to give us the amount of money that we actually receive. So what we can do is rearrange that formula to find out how much we're going to have to go out and raise given the amount of money that we need and the weighted average flotation cost. And so in this case, we've got 100 million that we need to raise, and we're dividing by 0.9. That gives us 111.11111 million. Now that's the amount of money we would have to actually go out and raise. That would be the amount that we include as our time zero negative cash flow of the money that basically went out in order to buy this thing, because we're going to have 100 million to buy it, or we're going to have to pay that extra in flotation costs. In fact, if I ask you right now, can anyone tell me how much were the flotation costs in this situation in dollars? Could you tell me? Ms. Volkova, what do you think? Okay, very good. Can you tell me in dollars, how much did it cost us to raise that money? Okay, let me run through this one more time. We're going to go out there and raise 111.11 million, but we only get to keep 100 million. Yeah, 11.111 million goes into the pocket of the investment banker. Does that make sense? Okay, questions? What if the flotation cost for stock here had been 0? What if we were using internal equity? Then our weighted average flotation cost would be just 2.5%. And we would be dividing by 0.975 instead of by 0.90. Our amount that we'd have to raise would be lower, and our flotation costs would be lower. Does that make sense? Okay. That is the end of chapter 12. Now we are on to chapter 7. So we told you early on that, so the first class in here, we talked about the 3 questions in corporate finance. Do you guys remember what they were? The 3 questions we're trying to answer as financial managers, what are they? Oh, yeah, so he's jumping ahead here. Yes, but that leads us to ask these 3 questions, right? We know, so what are we going to do? So number 1 is what assets should we buy? What assets should we buy? That's the capital budgeting question. The second one was how are we going to fund those purchases? That's the capital structure question. And the third one is how do we manage the short-term cash flows of the firm? And that was the working capital question, right? The working capital or short-term capital management kind of thing. Okay, now, so that first question says, what should we buy? And in order to figure out what we should buy, we have to have some decision rules. And that's what Chapter 7 is all about, is telling us about these different rules that we can use to determine what assets we should buy. Okay, so I've kind of told you that first bit to begin with, but I will tell you this. Some of these rules are better than others. And we're going to show that one of these rules rules them all. So you might say, well, wait a minute, that's just the one that I'll always use then. But what we're going to see is that some of these things are actually okay to use in certain circumstances, and other ones are better in other circumstances. So I'm going to teach you the rules, and I'm going to tell you the circumstances in which they might be a good choice. So we don't always have to do the top one. By the way, the top one requires more effort than any of the other ones. So that kind of tells you why we might be willing to use something else. So what makes a good investment rule? Well, first of all, it has to account for the time value of money. Would you rather have $1 today or a year from now? Today, for sure, and especially with inflation at 8.5%, we know that's an easy question to answer. So, even though 2 projects might create the same amount of dollar cash flows over their lives, when those cash flows come in are going to make a difference as to which one is the better project. Number 2, we have to account for the riskiness of the cash flows, because we know risk and return have to go together. Otherwise, we would end up we could have 2 projects have identical cash flow, and one could be extraordinarily risky and the other one extraordinarily safe, and they would look the same to us if the rule does not account for the riskiness of the cash flows. And then finally, because the goal of financial management is to maximize the wealth of the shareholders, what we need is something that gives us information regarding the wealth created by the project. Because as Mr. Sadai pointed out, the goal is to maximize shareholder wealth. Questions so far? Okay, as we go through these, what I'm going to do is I'm going to balance all of these rules that we look at against these 3 questions. And we're going to rate each one of these on a 0 to 3 star scale. This confuses the hell out of people who shop on Amazon, because how many stars are they expecting? 5, right? There are only 3 stars available here. So a 3-star measure will be a perfect measure. A 2-star measure will be better than a 1-star measure, a 1-star measure better than a 0-star measure. But for each one of these questions that we can answer yes, it gets a star. So let's start with net present value. Net present value, the book says that it is the sum of all the present value of all the cash flows subsequent to initial investment minus the initial investment. What does subsequent to mean? After. Very good. Thank you. Okay. Now, I would say, actually, I give you a little different definition here, and that is it's the sum of all the present values of all the project cash flows. And the negative ones are cash outflows and the positive ones are cash inflows. And the reason I put it that way is because some projects require investment in more than one period. For example, building a factory. We're talking 3 to 5 years to build a factory. So you're going to have negative cash flow, 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 and then you're going to have to start positive cash flows. That whole definition of minus the initial investment gets a little fuzzy when you have to make the investment over multiple periods because of time value of money. And so this is going to be the definition that I'll work off here. And what's our rule? It's accept all projects with net present value greater than 0 and reject all projects with net present value equal to or less than 0. Now, why do we say we accept all projects with NPV greater than 0? Because those increase shareholder wealth. Those increase shareholder wealth. Now, we're assuming that if we've got a positive NPV project, we can always get financing for it. So that's one of the assumptions of NPV analysis. And we're going to relax that assumption later on, and we're going to see that in that case, maybe NPV is not the best way to go. Now, the next question is this. People always ask, well, what about NPV equals 0? That's not going to destroy any shareholder wealth. Why shouldn't we do that? And the answer is, I'm going to give you 2 answers here. Number 1, I'm lazy, right? Why would I go out there and build a new factory and not gain anything for it? So that's the first reason I'm going to give to you. The second one is NPV is once again a swag. What does swag stand for? Scientific wild ass guess. Now, let me tell you about a project that I actually worked on. I was getting a new machine with $700,000. And we had already got the guy lined up to install it. We thought we had everything nailed down. And the machine, because production machines, the more stable they are, the better dimensional tolerances they can hold on machining. And so we looked at the manual, and it said we needed 12 inches of concrete to drill the anchors into for the machine to be stable. So we roll out the plans for the plant. The plant had been built in 1962. The year currently was 1997. So the building's about 35 years old. And we look at the plans, and it says that the depth of the concrete at the place where we're going to put this machine, 14 inches. It's 14 inches more than 12. Yeah. And so we should be just fine. And so the big day comes, the machine's here, the guy comes in, and he's going to drill holes into this concrete to anchor this machine. And here's what it looked like. What do you think happened? How thick was the concrete? 4 inches. 4 inches. Now, why do you think we ended up with less concrete than they told us we got? Do you think concrete, what do you think is cheaper? Dirt that's already there or concrete? Dirt that's already there. And so we had 4 inches of concrete, and then we had, to the center of the earth, Texas cotton field, right? Now, I can't put my machine on 4 inches of concrete and expect to get any parts worth anything off of it. And so what do I have to do? I have to, by the way, the NPV of this project was $25,000. Positive, we should have accepted it, right? So then I have to get in a guy, and they use a concrete saw and cut out a rectangle. Of course, it has to be bigger than the machine, right? And then they get a jackhammer, and they break all that up, and then they get all that out, and then they have to dig the hole down, and then they have to put reinforcing wire in the hole. And then, because, by the way, we didn't have those big concrete pumper arms like you do for swimming pools these days. I don't know if you guys have seen this. Totally cool. We didn't have that sort of thing back in 1997. And so what we had was a wheelbarrow brigade of people coming from the ready mix truck out in the parking lot, into the factory, dumping it in the hole, right? Okay. By the time we get back to basically just having a flat floor, we spent $40,000 on that on that hole, right? $40,000, and we haven't even started yet. Now, that means my initial cash flow was $40,000 higher than I expected it to be. I had an NPV of $25,000. What's my NPV now? Negative $15,000. Now, that was a positive NPV project. Sounded pretty good in the beginning, right? But I'm going to tell you from a perspective of answering on a test, NPV greater than 0, always take the project. In the real world, you need to ask yourself, wait a minute, what are the risks here and how much do I have to invest to make this happen? If I tell you a project has a 5,000 NPV and I only have to invest 10,000 to get it, that sounds pretty good. What if I have a 5,000 NPV and I have to invest $1 billion to get it? My common sense says, maybe not, right? By the way, I did learn from that mistake. After that, I always threw an extra 10% in for that initial cash flow. I called it a contingency. And after that, all of my projects came in under budget, but they never came in 10% below budget. They always came in like 3-5% below budget. In other words, cost overruns are almost always going to show up. Cost underruns, you notice we don't even have a good word for that, right? Cost underruns don't happen. And so that would be the danger of accepting a 0 NPV project or even a small NPV project. Questions?